ARK Invest has a huge problem. I don't know whether it's the entire firm or Cathie Wood specifically, but they will seemingly do anything to avoid investing in a certain kind of company. Highlighting these biases in other investors can help us see them in ourselves. So I hope this episode challenges your thinking and maybe even makes you a little money on your own investing journey. Your time is valuable, so let's get right into it. One of the most fatal mistakes any investor can make is having a bias against stocks that don't fit their personal narrative. That said, this video isn't about Cathie Wood just being wrong or about ARK Invest being somehow bad. I'm just using them as an example because Cathie Wood is always sharing her latest investment thesis in interviews. But here's the thing. ARK Invest is already limited in the stocks that they can buy because they manage thematic funds. For example, Cathie Wood can't just put Tesla stock into her genomics fund ARKG, even if she thinks it will outperform every other stock in that fund. So it's strange to me that Cathie Wood would also avoid making big investments in mega cap companies, even if they totally make sense as a part of her portfolios, especially in her flagship innovation fund, ARK, which can already have stocks from every other ARK fund in it. Well, about a week ago, Cathie Wood did an interview with Barron's, where she laid out exactly why she doesn't invest in most big tech companies. So I've cut down this interview to just the relevant parts, edited out all of the ums and ahs, and sped it up so that we have plenty of time to pick it apart together. And speaking of saving time and money, I'm going to let you in on a little secret. Between researching investments and making these videos, running this channel is like having two full-time jobs, so I'm really obsessive when it comes to managing my time and my money. Factor is the home delivery meal service that ships delicious and healthy food right to your door. Every meal is always fresh, never frozen, dietitian approved, and can be prepared in minutes. And honestly, it's like eating home-cooked meals, but without all the hassle of grocery shopping, cooking, and cleaning up afterwards. I can't tell you how much time and money Factor saves me each week, all of which gets invested right back into this channel. Factor's menu updates every week and has something for everyone, including keto, calorie smart, chef's choice, veggie, and even vegan options. So you can just pick your meals each week or sit back and let Factor pick them for you. Right now, I eat Factor every day for lunch, but I like that I can always add more meals or take a week off when I'm traveling. So if you want to eat healthier, save money, and have more time to invest in yourself, your family, or just your portfolio, head over to factor75.com or click the link below and use code tickersymbol50 to get 50% off your first Factor box. This is an awesome deal from an awesome company. Thanks to Factor and to you for supporting the channel. Alright, let's get right into the Cathie Wood interview. Here's the first clip from Barron's.
I want to get right to it. I want to start off with some kind of big picture macro questions and then talk more about specific holdings. It seems like right now, over the past few years, we've been in this era of groups of stocks. You've got FANG and now the Magnificent Seven, and they seem to kind of come and go quickly. What's your take on all that?
So if you look at what has happened to ARK after two very difficult years, we don't own most of the Magnificent Seven. We own Tesla in size, but the others either not at all or partial positions in our flagship strategy. And we have been able, through the second quarter, we outperformed even the NASDAQ 100, which is dominated by those stocks. Now, we're backing and filling now, so we'll see what happens as we enter the end of the year. I think interest rates moving up has given everyone pause, and so they're running back to their benchmarks. But I do think our outperformance in the first half, and it was significant outperformance, suggested that maybe underneath the market is broadening out. And that's a very healthy sign.
Fascinating. You mentioned the performance of ARK Innovation, the ETF, and it went to the moon several years ago, then came back down to earth hard, up year to date strongly, now backed off a little bit with the retreat this month. What do you tell investors? And do you sleep well at night? I mean, this is a roller coaster.
Well, we are a great diversification strategy if you want diversified innovation. We just wrote a paper, it's on ARK-funds, around artificial intelligence and how the market has rewarded Nvidia and Microsoft and left a lot of other stocks that are probably going to be bigger beneficiaries from this point on than Nvidia and Microsoft. Those are the stocks we're focused on. Nvidia has been primarily hardware historically. By our estimates, for every dollar of hardware sold around this innovation opportunity, AI, we think the software pull-through will be on the order, it depends on the estimate, but somewhere between 8 and $21 for every $1. So we think the market and investors broadly are overlooking some massive AI opportunities in other stocks, more software oriented.
So ARK outperformed the Nasdaq by about 15% from the start of the year through the end of July, going up by about 59% compared to the 44% up for the Nasdaq. But just a couple weeks later, the Nasdaq was beating ARK by around 10% year to date, and ARK is still trying to close that gap. The problem here is that ARK's management fee is 75 basis points, which is almost 4 times higher than the QQQ's management fee of just 0.2%. That difference in management fees can really add up over time, and Cathie Wood is justifying that fee with 3 main points here, which are filled with the big biases that I want to highlight. 1. Her funds are a portfolio diversification strategy focused on innovation. 2. That the market is rewarding mega-cap companies like Microsoft and Nvidia, but completely ignoring much smaller companies that are even bigger beneficiaries of AI. And 3. That ARK tends to stay away from hardware companies like Nvidia because for every $1 of hardware revenues, AI could generate between $8 and $21 in software revenues. Let's tackle these points in order. If you look at ARK Invest's family of funds, they're actually highly correlated with each other, meaning their prices all move together even though they're filled with very different stocks. This is especially true for their next generation internet ETF, ARKW, the FinTech Innovation Fund, ARKF, and their flagship innovation fund, ARKK, all of which actually have a pretty good amount of overlapping holdings. But the reason for this high correlation is actually that most of the companies inside ARK's funds are small, high-tech growth companies with little or no earnings and free cash flows. These are the exact kinds of companies that get discounted the most when interest rates are high, which is why they all move together even though they're completely different businesses. Instead, these funds are actually different flavors of the same strategy, which is to diversify away from the S&P 500 and the Nasdaq. And that's a problem because Apple, Microsoft, Google, Nvidia, Meta Platforms, and Amazon are the exact companies that have been performing well all year. According to ARK Invest's own research, these 6 companies are responsible for 70% of the Nasdaq's year-to-date run-up of almost 40%. And ARK Invest does care about performance since they expect every single stock they buy to grow at a 15% compound annual growth rate, or roughly double every 5 years. All of these mega caps are easily clearing that growth rate today. So why is Cathie Wood flat out refusing to have big positions in any of them? Well, here's how she responded to that exact criticism.
I want to follow up and ask about Nvidia, but just one more question about the fund and your work. People criticize you sometimes, Cathie, and I'm wondering, do you read that stuff? Does it get you down, or do you just keep carrying on with your work?
So my experience with truly disruptive innovation is the old guard, and the old guard are the names that have reached very high levels in many of the benchmarks, that they dismiss these technologies, which are simply nipping at their heels. And, we can talk about Zoom, for example, complete dismissal of Zoom as an AI opportunity. And so, Microsoft just dominates. There's no way Zoom can go anywhere. Well, I remember Eric Yuan when he started WebEx. At that time, Cisco, which nobody could beat Cisco, it was being treated like Nvidia is today. Cisco was developing, I forget how much they cost, maybe $500,000, these video consoles that would populate an entire room and do what WebEx ultimately did for a much lower price. And of course, Cisco bought WebEx. Well, Eric Yuan founded Zoom, understanding that enterprise communications was going to shift from on-prem, hardware-centric to the cloud. And, it is now selling at roughly 8 times this year's EBITDA and is a real value stock. Just wait until they start showing their AI chops. And we think that will start with Zoomtopia in early October.
This is where Cathie Wood's deep bias against big tech is really showing. This isn't the dot-com bubble era. Saying that the old guard is somehow dismissing these disruptive technologies makes absolutely no sense. The reason that Microsoft is dominating is exactly because it's not dismissing the most disruptive innovations out there right now, like large language models. Microsoft owns 49% of OpenAI, and they don't just own it, they're integrating GPT-4 in virtually every Microsoft product as AI copilots and doubling down on providing AI infrastructure with Azure. Not only that, but Microsoft isn't ignoring business communication software companies like Zoom and Slack either. They're directly competing with both of these products with Microsoft Teams. Microsoft Teams is the third largest video calling platform on the market, behind Zoom and Google Meet. By the way, Google Meet grew their overall market share by a whopping 10% last year. But I guess Google Meet doesn't count since Google is another mega cap company. Here's another point. Microsoft is currently working on moving their whole Windows operating system to the cloud because they see the same trend that Cathie Wood is talking about, which is more and more compute power moving away from individual workstations and towards cloud services. If Windows becomes a cloud service, then Microsoft can integrate Windows AI copilots much more deeply into the operating system and their apps without having to worry about all the different configurations and specifications that at-home PCs and laptops can have. Isn't that exactly taking a tried and true piece of software and innovating on it? So I'm not really sure how they can justify not holding Microsoft, which has also outperformed ARK year to date. But it's not just Microsoft. Listen to Cathie Wood's justifications for not holding Nvidia. By the way, Nvidia's stock has returned more than all of ARK Invest funds combined so far this year.
I want to go back to Nvidia because a lot of people are just discovering that company. And they would consider a disruptor, but it sounds like you're almost considering them an incumbent, a legacy company. Or is it just a valuation problem? Would you get back into the stock at some point, Cathie?
Right. So we took our initial position when we started the firm, and when it was $5 on a split adjusted basis, and we rode it all the way up, and we still own it in our more specialized portfolios, but at a much lower rate. Why? Because we're very sensitive to valuation, contrary to what many people might think. And according to our estimates, and our estimates for Nvidia are quite aggressive in terms of revenue growth over the next 5 years. We think they're in a beautiful position with the picks and shovels, but everyone knows it. Everyone knows it, and it is valued accordingly. So on this year's revenue, it is somewhere in, let's say, the 25 to 27 times sales range, depending on one's estimate. And we have other names in the portfolio on the software side. And remember, for every dollar of hardware, $8 to $21 of software are going to be pulled through, according to our estimates. Tesla is the biggest AI opportunity out there. It is the biggest artificial intelligence project in the world when it comes to autonomous taxi platforms. And it is selling for roughly, I think it's 7 times, maybe it's 6 times revenues now. We think that's the best example. But other software plays would include Twilio, which is selling at 2 to 3 times, Zoom, which is selling at roughly 3 times sales. These are all sales. And these companies have either very high gross margins, like Zoom, 80%, or they have low gross margins now, like Tesla does in the 20s. These are gross margins, but they will be rising because of this SaaS-like model that is evolving for Tesla. They will rise from the 20s into what we believe is the 50s and 60s. Not at all expected out there.
So ARK Invest prefers software companies to hardware companies since they predict between $8 and $21 of AI software revenue for every $1 of hardware revenue. And the biggest AI opportunity out there right now is Tesla, even though 85% of Tesla's revenues come from selling cars at 18.2% gross margins. And yes, I know that the plan is to eventually drive those margins way up by selling full self-driving software to Tesla owners and AI training services to other companies through Dojo, and eventually humanoid robots to do everything else. I'm not saying that investors shouldn't price those things into Tesla stock right now. But don't you think it's a little weird to consider those things for Tesla, but totally not consider the robots and software services and applications that Nvidia has built on top of their hardware, all of which are already being used across a wide variety of industries today? And isn't it a little strange to talk about how Tesla's software and service models will move them from 20% margins today to 50% margins in the future, while discounting the fact that Nvidia is selling their AI data center chips at 70% margins right now? Even if the argument is that these margins aren't sustainable, wouldn't they be if you priced in their future software revenues? After all, Nvidia showed us that they think enterprise software is just as big of an opportunity for them as their hardware business is today. Not to mention that Nvidia guided for even higher margins next quarter, so there's no real competition to their hardware just yet. If a lack of competition is a major argument for investing in Tesla, then why doesn't it also apply to Nvidia? Even the valuation argument doesn't really make sense. Even though Nvidia's price has more than tripled over the last year, their net income and their earnings per share are up by almost 9x, so their price to earnings ratio has gone way down over that time frame. Look, My point isn't to pick apart every little thing that Cathie Wood said in this interview. It's to help you avoid making a fatal investing mistake by sharing some clear examples of what I feel are unfair comparisons and justifications, with data and context to back it up. If you're a Tesla investor who thinks they have a bright future in AI software and services, you should at least acknowledge other AI software and service companies, especially outside the automotive market. Same thing with Palantir. It's totally fine to have a favorite stock that you really believe in and want to load up on. Just make sure it's because you're making apples to apples comparisons based on real metrics and market data, or else you could miss some pretty big winners just because they don't fit your narrative. Let me know what you think in the comments below. I'm excited to hear your thoughts. And if you feel I've earned it, consider hitting the like button and subscribing to the channel. That lets me know to put out more content like this. Either way, thanks for watching, and until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.